Your 401k is destroying your financial freedom. And while that might sound backwards, it's the truth. In this video, I'm going to explain why that's the case and what you can do to secure your financial future faster. See, tax-deferred retirement accounts can only be accessed when you're 59 and a half. Unless you're approaching your mid-50s, tax-deferred retirement accounts are more about legacy than they are about your retirement. See, most business owners come to me and they tell me my number one goal is to have financial freedom in the next 5 to 7 years. And while that doesn't mean that they completely retire, what it means is that they want the ability to retire. They have enough funds to be able to live comfortably and do the work that they want to do. But tax-deferred retirement accounts can't be accessed without penalties until you're 59 and a half. That's incredibly problematic if you're in your 20s, 30s, 40s, and to some extent even a little bit of your early 50s, that if you're looking to have that complete financial freedom in 5 to 7 years, when you lock up your money in your 401k that you can't access until you're 59 and a half, you've now gotten further away from your objective. It's funny how that happens, where we unintentionally design a system that gets us further away from the life that we want, further away from funding the goals that we want. Let's draw a parallel to this. Say that you have a bill or an investment that you want to make in the next year. Perhaps it's a house that you want to buy in the next 3 months. And so you've got some extra funds and you put it into a 24-month CD. What'd you do by locking it up into a 24-month CD? You got further away from your goal of buying that home in the next 3 to 4 months. That's what we're doing oftentimes by putting our extra resources into a 401k. We're locking it up for further than our stated goal of financial freedom. Now, that's not to say that a 401k can't be a useful tool, but it's to point out that it's not the first strategy we should be using. It might be the last strategy based off how far away you are from 59 and a half. And believe it or not, there are far better ways that you can fund your goals without locking up your funds until you're 59 and a half. Let me give you 2 examples today. Example number 1, real estate. With real estate, we're allowed to take losses, and I'll explain how we generate losses here in a moment, and offset 100% of business income. It doesn't matter how much business income you have, plus another $500,000 in any other sources of income, things like wages, interest income, stocks, stock gains, et cetera, et cetera. And so how does that work? Well, within real estate, there's 2 categories. There's short-term rentals and long-term rentals. By definition, under the tax code, a short-term rental is a property where the average stay for all tenants over the course of the year is 7 days or less. That's a short-term rental. If the average stay is more than 7 days, it's a long-term rental. Now, under both pathways, we're allowed to take something called accelerated depreciation. And to back up and explain that for a little, appreciation is this concept that we're going to take the purchase price, what you paid for the property, and take a tax deduction over a series of years, say 27 and a half years, long duration of time. But under the current tax rules, we're often able to accelerate some of that depreciation, meaning we're able to take a lot more of it now or in the first 5 years. Currently, on average, we're able to take somewhere around 20% of the purchase price in the first year. That means if you bought a $1 million property, you might be able to take a tax write-off of somewhere around $200,000. Now, even if that property is profitable, meaning you've collected more rents than what you've paid out in mortgage interest, maintenance, and any taxes and any other expenses, when you add in this large accelerated depreciation expense, it creates a loss on your tax return. And now we're able to take that loss and offset our other source of income as long as we meet the specific rules that allow for us to take that tax deduction. And they're slightly different for short-term rentals than long-term rentals. Short-term rentals, you need to materially participate and have at least 100 hours. And if you don't have the most amount of hours, then you're going to need 500 hours. Long-term real estate essentially requires you to have a minimum of 750 hours, but it needs to be your primary job. More than 50% of your time needs to be in real estate. Typically, the long-term real estate option is going to be difficult unless you or your spouse has made that their primary focus. So oftentimes, clients are starting with short-term rentals because oftentimes they might also want to purchase a vacation property, and they're able to utilize the tax benefits to purchase the property, treat it as a short-term rental, and then eventually transition to using that as their vacation property. So they get a tax deduction that funds a goal that they already have. Love that. High leverage strategy. Or even if you don't intend to use it as your own vacation property, you're able to unlock these tax savings, take the money you would have been paying to the government, repurpose it towards buying more properties, which allows you to continue to build up a stream of passive income. Now, this is not specific investment advice. Every property is different. You need to do your due diligence and make sure that the properties fit your investment criteria. I'm merely speaking about the tax benefits specifically and how you can utilize that to build a portfolio for you that isn't going to lock you in until you're 59 and a half. Real quick, if you're watching this video and you're thinking, Dan, how could you be my CPA and we could do this all together? Well, go down to the pin link below, in the description below, click on the first link. That's going to take you to my website where you can schedule a quick call and see if it makes sense to work together. Now let's get back to the video. Now the second strategy involves life insurance. Life insurance functions very similar to Roth IRAs or Roth 401ks. With a Roth account, you don't get a tax deduction for the money that you put in, but you get tax-free growth on that income. Life insurance is similar. You don't get a tax deduction for the money that you put into the life insurance contract, but it can grow tax-free, or the payout is tax-free. So life insurance functions similar to a Roth IRA. And there are ways to modify the life insurance contract so that you can use it essentially as a line of credit. That's a concept called infinite banking. Or you can use it if you're a qualified client, typically meaning you have a net worth of $2.5 million or above, or qualified purchaser, liquid net worth of $4.5 million or above. You're able to access something called private placement life insurance, which is kind of the next level up from infinite banking, which is going to allow you to put significant sums of money into this contract each year and invest in a broader stream of investment products than you could with the infinite banking structure. So both are opportunities for you to make investments, but not lock yourself into being unable to access the capital until you're 59 and a half. Those are two examples. There's other things that you can explore as well, and I'm sure I'll break those down in other videos. But the point that I'm trying to make is that we need to make sure that we're designing a system with how we're investing our money so that we're guaranteeing or getting as close as we can to guaranteeing the outcome that we want. So again, this means that your tax-deferred retirement accounts are not retirement accounts. They're about legacy if you've played the game correctly. And why do I say it's about legacy? Well, if you fully funded financial freedom in your 30s or 40s or even early 50s, then that means all the money that you put into your 401k, you don't need for day-to-day living. That means you can use that for philanthropy of all sorts. You can use that to pass on generational wealth. You're not reliant on it for your day-to-day spending. And it's painful for me to see so many Americans who have designed the system that guarantees they're working until their late 50s or even later than that, unknowingly. Now, it's fine if you're opting into it and you're knowingly saying, my goal is 59 and a half or later. But if your goal is in the next few years, and that's still a pretty large gap from 59 and a half, then we need to redesign the system for you so that you get the life that you want. Biggest risk in life is not living the life that you want.